Hello, very good morning to all. I'm Kelvin here again. Welcome back to today's Daily Dose of Market Insights. Very good morning. Today will be the Thursday, the 22nd of May, 2025. So as usual, let's have a quick look at the disclaimer first. All right, I believe that the screen is moving. Okay. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap of what has taken shape yesterday in terms of news flow, economic data release, and as well as their impact on the intraday performance on the various broad-based cross asset classes over here. So let me start with the data flow first. All right, the economic data flow for yesterday. Okay, let me open up the chart of trading economics, because I'll share with you one key data that took shape yesterday, and as well as today's Asia session. Right, so today will be yesterday will be Wednesday. Okay, so yesterday data pretty much more centered on the FX market. So it's the inflation data out from UK. So the core inflation rate actually rose more than expected. So it came in at 3.8% year on year in UK for the month of April, way above 3.4% that was printed in March, and also above expectation of 3.6%. So if you look at the core inflation rate in the UK, the inflation trend in UK seems to be much more sticky on the upside right now. Also, bearing in mind that there is this also risk of this kind of what I call negative feedback loop that is being triggered down due to global higher trade tariffs right now, despite the fact that we are now still in the process of US still in the process of negotiation with the rest of the world, but the base tariff of 10% still remains that intact, right? So let's look at the trend, right? So if you look at yesterday's print of 3.8% for the month of April for the core inflation rate in UK, actually is the highest reading since April 2024. So that's about a year high. So if you look at the 10-year trend, right, it's actually seems to be forming a mini basing formation after that deceleration in inflation trend that took shape from May 2023 all the way up to the third quarter of last year. So there seems to be a mini basing formation. So any push up in the next month or the month or two above 4%, that should raise alarm bells in UK, and potentially that should actually see more cautious guidance on Bank of England officials that in the current process they are in an interest rate cut cycle. So with the latest core inflation print in UK showing uptick, showing trend of a sticky inflation trend in UK rather than a inflation deceleration trend, it actually supports a much more cautious tone in Bank of England among the minds of Bank of England, and that actually supports ongoing sterling strength in the FX market and has a negative spillover impact on the US dollar. So if you look at the US dollar trend, the dollar index has been steadily declining since the bearish breakdown of its 20-day moving average, and right now we have two consecutive sessions trading below the 20-day moving average. And what it means that the rally from the low of 22nd of April all the way up to this 12th of May high. So this very strong bullish Marubozu candle is triggered by that trade tension de-escalation between US and China over the Switzerland trade weekend, over the weekend Switzerland meet up between US and China officials to actually kind of have a 90-day pause among themselves with a lowered tier tariffs. But however, from a technical analysis perspective, the dollar index movement in the last three sessions indicate that the rally from 21st of April all the way up to 12th of May got rejected by the 50-day moving average at a medium-term pivotal resistance at 101.92, and also broken down below this parallel ascending this ascending trend line that is in place since 22nd of April, trade below the 20-day moving average for the last three consecutive sessions, indicating that the rally from 21st of April all the way up to 12th of May is corrective in nature. That means, i.e., is a dead cat bounce within a medium-term downtrend still remains intact on the US dollar index. So what does it imply? It actually states to us that potentially in the next multi-week perspective, the dollar is likely to be on a weaker trend rather than the start of a medium-term bullish reversal trend. That means we're talking about a medium-term downtrend on the US dollar from a multi-week perspective rather than a bullish reversal uptrend phase. Okay, so if you look at the across the board from a 5-day rolling performance basis, the US dollar is also weakening gradually as well among all the other major currency. Also starts to see lack of strength against the Aussie dollar. Like I explained, that the Aussie dollar managed to survive at the 64 figure level despite a much more dovish stance or dovish vibe that is being triggered off by Tuesday RBA meeting. All right, so the dollar is the weakest against the yen, which also came in within our expectation, where we start to see that bearish breakdown of their 20-day moving average and the failure bullish breakout as well, which actually I will highlight again on the daily chart of the dollar yen, which I have been doing so at the start of this week, indicating that the yen strength may be back into the picture, which actually came back within our expectation, especially the breakdown of that downside trigger at 144.10 with a daily close below it yesterday. And not too far back will be the dollar weakness against the Swiss franc and the dollar weakness against the euro dollar over here. All right. So net overall dollar weakness was the key theme yesterday, and also the fact that why dollar is getting weak, because right now market participants are getting a bit uneasy of owning longer term US Treasury bonds or US Treasury debt, and also that actually pretty much reinforced that Moody ratings downgrade on late last Friday. So yesterday, there's this particular news flow where the Treasury bond market, the US Treasury bond market, so we're not talking about the 2-year, 5-year, is the 10-year and beyond. So the market is actually the US Treasury bond market, so the longer 10-year maturity date. Investors, traders demand a higher or higher term premium for owning these longer 10-year bonds. So what they did over here is that the concern is about due to budget deficits in the US, all right, over here, and also concern about that US tax bill, all right. So we know that this week the House is the US House. We know US there's two chamber. One is the House, one is the Senate. So the House is now debating for that rather aggressive tax cut plan, which Trump advocated during his campaign pledges. So that will actually add on to what I think 300 over 80 billion of extra deficit in the US budget. So because of that, that actually giving the bond market is giving a warning sign to policymakers that fiscal sustainability issues cannot be ignored, and investors are pricing in a higher risk of fiscal deterioration in the US, leading to a rise in yields, okay, the longer term bond yield. So what do I mean by this? So if you look at the trend of that longer term bond yield over here, okay, so this is the 10-year Treasury yield. Okay, right now it has a daily close above the 11th of April high. All right, at 4.6%. Right, and if you look at the 30-year bond yield, right, the 30-year bond yield, and if I go to the weekly time frame chart over here, let me remove this. Okay, so this is the 30-year US Treasury bond yield. Okay, right now it's actually shaping a major bullish breakout from the 52-week high that was printed previously on 16th of October 2023. So this rising bond yield at that point in time from the second quarter of 2023 all the way up to the third quarter of 2023, this has been pushed up by the risk of stagflation fears. And also stagflation fears also right now is also back into the US, where I actually covered on the previous 2 days of daily dose, where I shared with you all the University of Michigan consumer sentiment deteriorate to almost a year low, and we start to see a 30-year high in 1 and 5 year inflation expectation as well. So what you see over here is, if you look at this, let me highlight it. All right. So right now it's a time to do a bullish breakout from this sideways ranging configurations that is in place since October 2023. So that's about close to about 1.5 year of consolidation, and we start to see a bullish breakout taking shape this week. And right now trading above the psychological level of 5% at 5.08% as you are speaking. So if we have a potentially, if we could have a weekly close above this dotted red line over here, which is at 5%, 4.96% to be precise. So it indicate a major bullish breakout on the 30-year treasury yield. So what does it imply over here in terms of macroeconomic perspective? That means, number one, do not forget the US Treasury market. The yield of the US Treasury market is being used as a benchmark risk-free rate to price corporate loans, price housing loan, and as well as price some form of consumer loan. So it's being used as a benchmark for loan pricing, because they, being the risk-free rate, has been deemed by global market participants and by the global markets. And 30-year is considered as a longer term tenure. So that is being used to price longer term loans. So with the 30-year US Treasury year pushing up higher, that means i.e. down the spectrum, corporate loans will be much more pricey with a higher interest rate price tag that's being attached to it, and that potentially could actually clamp down interest burden. And also that should potentially clamp down, I would say, capital investment plans by corporates. That means why? Because corporates may not want to actually finance their corporate investment plan or fixed asset investment plan, because right now they are actually potentially seeing a higher cost of funding. And for those debts are about to roll over, so they may start to actually, corporate debts are about to roll over, they will actually roll over at a higher interest rate cost. So net overall, that actually potentially could clamp down, put a cap on future profit margin, which eventually will start to see a earnings revision downgrade on rather than upgrade in US corporates earnings in the next Q3 and even in Q4 down the road. And that, because of that, that actually explained to us the across the board sell off in the major US stock indices yesterday, where the SPX is down by negative 1.6%, the Nasdaq is down by negative 1.3%, down by negative 1.3%, the Dow Jones down by negative 1.9%, and the worst hit was the Russell 2000, being they are actually has a lower credit standing, so any increase in long-term interest rate doesn't gel well for the Russell 2000 small cap companies, so that they actually underperformed yesterday by negative 2.8%. So what's interesting, later I'll cover the Nasdaq 100. So yesterday at the start of the US session, 2 hours into the start of the US session, they attempt to actually hit our resistance level again at 21,400, but can't break above it and starts to shape this intraday bearish reversal. So things doesn't seem to be too rosy for the short-term bulls right now on the US stock market after yesterday's intermarket movement on this major cross asset classes. So right now what we see over here is that we start to see a strengthening of the US Treasury longer term yields that lead to potentially a sell-off in US Treasury bond. A sell-off in US Treasury bond lead to lesser demand for US Treasury sovereign notes and bond. That means people are now less attracted to actually buy US Treasury bonds or US Treasury notes as per se. This is the longer term US sovereign debt instrument that lead to lesser demand of US dollar. So the US dollar collapse, and the US dollar collapse over here lead to a, that now start to see a sell off in the major US stock indices, because the major US stock indices market participant has started to realize that if the 10-year, if the 30-year and the 10-year US Treasury yield, especially 30-year US Treasury yield, manage to shape this major bullish breakout, that means having a weekly close above 4.96%, that could potentially lead to a persistence uptrend in the US 30-year Treasury yield, the 30-year US Treasury yield, eventually higher cost of funding for US corporation, eventually putting downside pressure on US profit margin. All right, so that led to the sell-off in the major US stock indices yesterday. Major sell-off in the US stock indices lead to a mini risk-off event. So this mini risk-off event continues to support our bullish bias on the gold. So recall that gold last week I already mentioned that 31.30 is a key medium-term support level with the 50-day moving average, and it managed to actually survive at the 50-day moving average. So let me open up the chart of gold for you guys to see. Okay, so gold price continues to rally at the 50-day moving average over here. After that bullish reversal, now clear above the 20-day moving average yesterday at 3,305. So right now, very clearly, this corrective movement from 22nd of April all the way down to the low of 15th of May have ended. That means right now we are at the start of an impulsive up move sequence, potentially retesting fresh or the all-time high at 3,500 before scaling new all-time high again, because right now is the start of an impulsive up move sequence potentially. So gold continues to remain bullish in today's Asia session. Added on another gain, intraday gain right now as speaking 0.8%. So later I'll share with you what is the intraday key levels to watch out for today when I cover the second segment of today's daily dose, which is the intraday technical outlook. All right. So one thing I want to share with you over here is that despite the fact that the major US stock indices decline, we continue to see pretty much firmer resilient in the major European stock indices, where we start to see the German 30 or the German DAX managed to close higher at 0.4% or 0.36% to scale fresh all-time high over here. And one of the reasons why the German or the European stock market is so firm against the US market is because they have a lower price valuation, and also given a weaker US dollar right now is actually diversifying away, or I would say that long only fund managers are now trimming off their previous 5-year plus or decade plus of US exceptionalism capital allocation. They reduce the US stocks in their portfolio and increase and overweight their weightings in the rest of the world, especially in Europe, given the fact that Europe right now is in the pace of expansionary policy. Liquidity, increase in liquidity by ECB, which is still dovish, and also the German, the government in the new government the new government in Germany is advocating a fiscal expansionary plan. All right, so that's explained the outperformance of the German DAX against the major US stock indices yesterday. All right, and also we have this positive news flow between the ongoing trade tension between EU and US. So EU yesterday sent a new trade proposal to US instead to secure a deal. All right, so what it means that over here is that the new paper includes proposal to take into account of US interests, including international labor rights, environmental standards, economic security, and gradually reducing tariffs to zero on both sides for non-sensitive agriculture products. All right, so that means i.e. EU seems to be now more acceptance of US beefs heading into the European market. So that actually also sparked another positive feedback loop into the Germany stock market yesterday. Right, so that's Okay, that's potentially sum up. Okay, before I go, I want to share with you all one fundamental and intermarket dynamics. So that's I share with you all why earlier on the push up in the 30-year US Treasury yield is creating a negative feedback loop in the major US stock indices. So now let me share with you what happened when there is a major bullish breakout on the 30-year US Treasury yield, and how does it impact the S&P 500 in the last 5 years. All right, so these are the fundamental and intermarket dynamics segment. Okay, let me open up the chart. This is the chart over here. Okay, so at the top of my chart, this is the 30-year Treasury bond yield. At the bottom is the S&P 500. Okay, let me put it in writing so that you guys could see. S&P 500. All right, so this is in pink over here. All right, so this is the S&P 500. The top is the 30-year US Treasury bond yield. Okay, so bear in count, we notice that every time there's a major bullish breakout, okay, so major bullish breakout is talking about at least 1 year of down movement before the price breakout. So previously, the Treasury yield from 15th of March 2021 all the way down to November 2021, and it managed to stage a breakout somewhere around in January over here, January 2022, so about a year of down movement. There's a bullish breakout. So upon this bullish breakout on the US 30-year Treasury bond yield, so this is a weekly chart over here. Yes, a weekly close above this major descending trend line. It led to that significant decline on the, let me put it in dark, in bigger, all right, over here. It led to a significant corrective decline on the S&P 500, right, over here. It declined over here. And what I could see previously, once the pullback take shape on the US 30-year Treasury bond yield from the high of October 2022, then finally it broke out in July 2023 over here. There's a bullish breakout. There's also a corrective decline on the S&P 500. Okay, recently there's this bullish breakout that takes shape on the 12th of November 2024 after a consolidation since 23rd of October 2023. That's almost a year. So at the November 2012, the 12th November week 2024, there's a bullish breakout in the 30-year Treasury bond. The US stock market inch higher but can't maintain momentum, and finally did that corrective pullback on 10th of February all the way down to the low of 31st of March over here. Okay, then right now what we could see, the latest one is this ongoing major bullish breakout. So we need to have a weekly close above it. So we have, as long as a weekly close above this this descending trendline resistance, which is at around the 4.96 level, which I shared with you earlier, or 4.97 level, which I shared with you earlier on in that earlier chart. There could be a risk that the S&P 500, no, the S&P 500 may shape a significant corrective decline again, as what it did in the past few occasions. And bear in mind, this is a weekly chart. That means, i.e., it will last for more than a week. All right, potentially. All right, so something to take note of as market participants now starts to factoring in a higher interest rate cost, in the higher long-term interest rate cost in the US economy, and with the US Federal Reserve still opting to a wait and see approach in their current interest rate cut cycle. All right, so that sum up the second segment of the daily dose, which is the intermarket segment. So let us now move on to the third segment today, which is this so-called short-term intraday technical outlook on the major cross asset classes. Okay, so as usual, let me expand my screen so that you guys will have a better view of the charts. Yeah, so let's start with the FX market. All right, so hopefully the screen, you guys can see the screen. All right, so let's start with the euro dollar. All right, so the euro dollar continues to inch higher as expected over here. Hit our first resistance before trading in a minor pullback fashion during the European session, and right now attempting to form a higher low over here. All right, so it seems to us that right now there is a mini ascending channel that starts to form. okay, from the minor swing low of 16th of May. And the hourly RSI continues to bounce above the 50 level mark. All right, so indicating that short-term intraday bullish momentum still remains intact. So with that, we will have a slightly adjusted upward short-term pivotal support for today on the euro dollar using 1.1280 as my Titan short-term pivotal support level, which is also close to the 20-day moving average, acting as a pivotal support, acting as a similar support level as well. 1.1280 Titan short-term pivotal support on the euro dollar, still maintaining that intraday trend bullish bias. Above 113.70 potentially sees the next resistance coming in at 114.25, which is now also confluence with the upper limit of this minor ascending channel that I drew from the low of 16th of May. Only an hourly close and a breakdown below 1.1280 that would invalidate today's intraday trend bullish bias to kickstart a minor corrective pullback to expose the next near-term support level at 1.1215. Only a breakdown below 1.1215 will see a deeper pullback for the next near-term support level to come in at 111.35, which corresponds to the rising 50-day moving average. So overall, in a nutshell, still maintain our intraday trend bullish bias on the euro dollar using a Titan pivotal support for today at 1.1280. Next up will be the sterling dollar. So the sterling dollar right now is attempting to hit our first resistance level again at 134.40 after yesterday doing a minor sideways range consolidation. Hourly RSI also now inching back up above the 50 level mark over here as it's going to trace up a series of higher low. All right, so indicating that short-term intraday bullish momentum still remains intact on the sterling dollar. So with that, we will use a slightly adjusted upward pivotal support for today at 133.35. We also correspond to the 20-day moving average as well. So as long as price action didn't break down below 133.35, we will maintain our intraday trend bullish bias. The next resistance level to watch after 134.40 will be at 135.05, followed by 135.50 next, which is also a Fibo extension level in this ongoing impulsive up move sequence that is still intact since the low of 12th of May. Right, so I do the Fibo extension level, that is the 1.382 level. However, if price action starts to have a bearish breakdown and hourly close below the adjusted upward pivotal support for today on the sterling dollar, which is 133.35, that would invalidate today's intraday trend bullish bias to kickstart a minor corrective decline sequence or minor corrective pullback scenario on the sterling dollar, exposing the next near-term support level at 132.50. A breakdown below 132.50 sees a deeper pullback towards the 132 figure level. So that's for the sterling dollar. Up next will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar continues to hold at the 64 figure level as it continues to churn within this kind of complex sideways range configuration, a very tight one, since the low of 17th of April. So it's been trading in this kind of sideways range configuration since 17th of April. So that's close to about a month already. All right. So still no change for sure. 64 figure level will still be my key short-term pivotal support. Why? Because it managed to survive since 15th of March. Every time it tests above it, there's a bounce. But after this bounce, there's this rather stubborn near-term ceiling that can break, which is the 64.60. Yesterday, it also attempted to test at this level before shaping that pullback. And right now, there's some form of bullish pressure coming back into the picture by this bullish hourly candle that's been formed an hour ago. And also the RSI managed to help above a ascending trend line support level as well and inching back above the 50 level mark. Right, so no change for sure. 64 figure level, short-term pivotal support. We still have that intraday trend bullish bias, but we're in a sideways range configuration. Price action got to break above 64.60 before exposing 65.15 level. All right, 65.15 level over here. However, if price action break down below an hourly close below 64 figure level, today's intraday trend bullish bias will be invalidated to see a slide down towards the lower limit of this sideways range, which is 63.60/63.60 over here, which also correspond to the rising 50-day moving average as well. So that's for the Aussie dollar. Lastly will be the dollar yen. So the dollar yen, as expected, continues to slide down as expected. Let me share with you the daily chart again. So what do I mean by this? This push up on 12th of May or pop up induced by that US-China de-escalation has already been game over. Why? Because price action has a daily close back below this medium-term descending trend line from 10th of January 2025, indicating that the medium-term downtrend in place since 10th of January 2025 still remains intact, and that push up on 12th of May is considered as a fake or a failure bullish breakout, and price action yesterday closed below the downside trigger level of 14410, have a daily close below it, and also a daily close below the 20-day moving average. So indicating that right now the dollar yen has a high probability of resuming its downside bearish impulsive downward sequence within its medium-term downtrend, indicating that there is a higher odds of breaking below the 140 figure level, which is the swing low of 22nd of April, and potentially it may expose 138.90 next and 137.10, 136.50 next in the weeks to come. Right, so that's for the daily time frame chart. So what's the outlook and key level to look out for today, which is the intraday time frame chart? On the hourly chart, we'll still maintain our intraday trend bearish bias. Why? Because there's no clear signs of bullish divergence that's being formed on the hourly RSI. Hourly RSI still remains bearish over here with a parallel descending trend line that can't break above the 50 level mark. So with that, we'll use a slightly adjusted downward pivotal resistance level for today at 14460. We also correspond to the 20-day moving average and also correspond to the intraday high yesterday, the intraday high in today's Asia session at 14441 that got rejected and shaped a lower low. So as long as this slightly adjusted downward short-term pivotal resistance holds on the dollar yen at 14460, we'll still maintain the intraday trend bearish bias. A breakdown below 14235 may expose the next near-term support at 14105, which is the 2-time Fibo extension on this ongoing minor downtrend phase in first step from 13th of May, minor swing high, and also the minor congestion area of 21st of April and 22nd of April at 14105. Only an hourly close and a push up above 14460 that would invalidate today's intraday trend bearish bias on the dollar yen to see a squeeze up to retest the 50-day moving average, I think, as the next intermediate resistance level at 14620. Right. Now, let us move on to the major stock indices over here, starting with the Hong Kong 33. So the Hong Kong 33 continues to be in a very bullish dynamic. Where you could see, yes, we see a minor pullback over here, but right now the price action has started to turn positive with ongoing bullish hourly candle right above our short-term pivotal support that we highlighted at 23,370 yesterday, which is also the lower limit of this minor ascending channel that is still in place since 16th of April. So still no change. Continue to watch the 23,370 short-term pivotal support level to maintain our intraday trend bullish bias on the Hong Kong 33. First resistance level to watch will be the 23,970, 24,040 resistance zone, where yesterday price action attempt to retest this level before shaping that minor pullback as in today's Asia session and yesterday US session. A breakout above 24,040 may expose the next intermediate resistance at 24,350, which is the 1.382 Fibo extension taken from the low of 9th of April, and as well as the minor congestion area of 17th of March. Only a price action breakdown and the hourly close below 23,370 short-term pivotal support on the Hong Kong 33 representing the Hang Seng Index that would invalidate today's intraday trend bullish bias to kickstart a minor corrective pullback sequence or scenario, exposing the next near-term support level at 22,970, 22,680, which confluence with the 20-day and the 50-day moving average, I think, as a support level as well. And if you look at, there is going to be a potential bullish crossover from the 20-day moving average above the 50-day moving average. So that also justified reinforce our intraday trend bullish bias that we will remain intact, as well as 23,370 short-term pivotal supports hold. Now, next up will be the Japan 225. So the Japan 225 continues to plunge lower as expected, now breaking below the 20-day moving average, all right, over here. So as we could see, price action on the hourly RSI hit the oversold level, but there is no bullish divergence, all right. Price action of the RSI trade lower low, in line with the lower low of the price action on the raw price action on the Japan 225, representing the Nikkei 225. So with that, we will use yesterday's US session rejection level or zone at 37,435. So as long as price action didn't surpass above 37,435, there could be a bit of minor bounce taking shape for today during the start of the European session, given that the hourly RSI has started to exit from the oversold region. So as long as this minor bounce didn't surpass above the tighten short-term pivotal resistance level at 37,435 for the Japan 225, we'll still maintain our intraday trend bearish bias. Next support level to watch in near term for today, 36,630. A breakdown below it exposes 36,260, which correspond to the 50-day moving average as well. Only an hourly close and a breakout above 37,435 that would negate today's intraday trend bearish bias to see a push up to revisit the 200-day moving average, acting as the next intermediate resistance level at 37,925. Only a breakout and hourly close above 37,925 that would reinstate the bulls to kickstart a brand new fresh impulsive upmove sequence for the next intermediate resistance to come in at 38,460, followed by 38,850 in the first step. So that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 managed to hit our resistance zone. At 34,170/190, a fresh all-time high before staging that pullback, and the pullback managed to held above our first support level at 23,900 level, right? This level at 23,900. So with that, I don't want to tighten my short-term pivotal support to be so tight at 23,900 because it can't surpass above 24,190 unless we have an hourly close above 24,190. Then I could tighten my short-term pivotal support for today once the European session kickstart at 23,900 level. So I'll be still using the 23,670 as my short-term pivotal support level to maintain that intraday trend bullish bias on the Germany 30. The next resistance level to watch out for will be 24,440/24,560, which is so defined by a Fibo extension cluster. And also the hourly RSI continues to hold above this parallel ascending parallel support level at around the 42 level mark over here. So only a price action and a breakdown of hourly close below 23,670 that would invalidate today's intraday trend bullish bias on the Germany 30 to see start to see another round of minor corrective pullback scenario unfolding, exposing the next near-term support area at 23,380, 23,040, which will correspond to the rising 20-day moving average as well. So that's for the Germany 30, still maintaining our intraday trend bullish bias using 23,670 as my short-term pivotal support level, unless we have an hourly close when the European market opens above 24,190, then we could tighten our short-term pivotal support level to 23,900. Next up will be the major US stock indices, starting with the Wall Street 30, representing the Dow Jones Industrial Average. So yesterday we do have a tightened short-term pivotal support for a better risk management perspective, which is at 42,190. Price action can't hold above this level and break down and hit the next support level at 41,770 before stalling, right? So right now the hourly RSI is now deeply in oversold region. So this oversold region is the most deep level since the 5th of April or 4th of April, all right? So it's something like a close to a 4-week low in the RSI oversold level. So if a 4-week low in the RSI oversold level, there could be a minor bounce taking shape. So minor bounce may bounce up towards the 42,190. The 200-day moving average price action managed to reintegrate back below the 200-day moving average, indicating the lack of bullish pressure or the lack of bullish sentiment, which is at 42,433. So watch out for this intermediate resistance zone at 42,194, 42,433. So this will be my, let me put it down. So this will be my short-term pivotal resistance level, 42,430. All right, so let me remove this. Okay, let me put it in nicely again to recalibrate with the latest price action. Okay, 42,430. 42,430 ST pivot is the 200-day moving average. Okay, over here. Okay, so as long as the bounce didn't surpass the potential bounce that may take shape at the start of the European session, because price action on the hourly RSI is in deeply oversold, so there could be a minor bounce, and price action managed to kind of hold above this support level at 41,770 for now. So as long as this minor bounce didn't surpass above 42,430, short-term pivotal resistance that I have for today on the US Wall Street 30, potentially there could be some form of bearish pressure coming back into the market, also driven by the fact of that 30-year Treasury yield inching up higher as well, where I share with you all in the first two segments of today's daily dose. So with that, flip to a intraday trend bearish bias for the US Wall Street 30 using 42,430 as my short-term pivotal resistance level. Below 41,770 exposes the next near-term support zone at 41,350/41,135, which confluence with the 20-day and the 50-day moving average as well. Only an hourly close above 42,430 that would invalidate today's intraday trend bearish bias to reinstate the boost for another round of impulsive up move sequence, revisiting 42,870/43,085 in the first step. So that is the US Wall Street 30. Next up will be the Nasdaq 100. So as usual, the Nasdaq 100 can't break above the 21,400 resistance level that we have in the start of this week. 1 time, 2 time, 3 time, 4 time, and it break down. And the way it break down, it also broke below the ascending channel, minor ascending channel support level that is in place since 22nd of April. So that doesn't gel well for the boost, right? Despite the fact that it still managed to hold above our short-term pivotal support as we are speaking right now. So yesterday we do have a tightened short-term pivotal support at 21,040, but based on the latest price action on the US Nasdaq 100 and based on the intermarket relation with that bullish push up in the 30-year Treasury yield, the 30-year US Treasury yield, we are not so convinced to maintain our intraday trend bullish bias on the Nasdaq 100, and there is a high probability that the 21,040 may not hold as the European session kickstarts thereafter. So I'll be using 21,400 as my short-term pivotal resistance level. We will flip to an intraday trend bearish bias on the Nasdaq 100. Below 21,050 exposes 20,690, and 20,690 gives way, you may see 20,390 coming in next, which confluence with the 200-day moving average and the 20-day moving average, and as well as this medium-term ascending trend line from the low of 7th of April. Right, only an hourly close and a bullish breakout above 21,400 that would invalidate today's intraday trend bearish bias to reinstate the boost for another round of impulsive up move sequence to unfold, for the next resistance to come in at 21,750 level. So that's for the Nasdaq 100, flipping to an intraday trend bearish bias using 21,400 as my short-term pivotal resistance for today. Next up will be the commodities asset classes, starting with gold XAU/USD. So gold XAU/USD continue to push up and almost hit our resistance level at 3,360, clearly surpassing the 20-day moving average. So with the RSI now back at the overbought level again, potentially there could be a minor pullback taking shape at the start of the European session. As long as this minor pullback didn't surpass below the tightened short-term pivotal support level that I have for today, which is 32.90, we will still maintain our intraday trend bullish bias for gold XAU/USD. Next resistance to watch after 33.60 will be 34.17, 34.35, which is the minor swing high area of 7th of May and 8th of May. Only an hourly close and a breakdown below the tightened short-term pivotal support level at 32.90 that would negate today's intraday trend bullish bias for gold to see a minor pullback taking shape, exposing the next near-term support level at 32.52. Only a breakdown below 32.52 will see a deeper pullback towards 32.04. That is also correspond to the rising 50-day moving average as well. So that's for gold XAU/USD, still maintaining our intraday trend bullish bias. Potentially there could be a minor pullback taking shape as well as this minor pullback didn't surpass below 32.90 tighten short-term pivotal support. For today, we'll still maintain that intraday trend bullish bias for gold. Next up will be the West Texas crude oil over here. So let me share with you all the West Texas crude oil. So the West Texas crude oil, despite on Monday there's this is the daily chart. Yeah, on Monday there's this push up over here. So this push on Wednesday, that this push up to retest the 50-day moving average, but after that retest of the 50-day moving average, price action can't actually maintain the upside momentum and shape a daily bearish shooting star candlestick over here. Also with this daily bearish shooting star candlestick, we are now not so convinced that the West Texas crude oil may shape a intraday corrective rebound sequence unfolding. And with that, despite the fact that it's still holding above the 20-day moving average, which is our short-term pivotal support level that I have for yesterday at 61.30, it seems that there is some headwinds for West Texas crude oil to be not able to actually have a proper breakout above the 50-day moving average that is now acting as a key intermediate resistance at 64.06 over here. All right, so it seems to us that if you look at the low of this, the low over here. Okay, where is it? Okay, let me do a proper one. Okay, since the low of 9th of April, the price action on West Texas oil seems to be evolving in this kind of triangle-like configuration. All right, and in the last two sessions on 14th of May and Wednesday, 21st of May, it can't break above the 50-day moving average and starts to shape that bearish price reaction of the upper limit of this potential symmetrical triangle range configuration, and coupled with the daily shooting star candlestick that I share with you on the daily chart over here, it seems to me that the bears are more in charge on the intraday basis rather than the bulls. All right, so with that, I will flip back to a intraday trend bearish bias for today on the intraday basis, for sure using the 50-day moving average, which is the 64.06. That will be my short-term pivotal support level. Two near-term support level to watch will be 61.30 followed by 60.30, 60.35. A breakdown below 60.35 may see further weakness to expose the minor swing low area of 8th of May and also the congestion area of 2nd of May and 5th of May at 58 figure level. Only a price action bullish breakout and hourly close above 64.06 that would invalidate today's intraday trend bearish bias within that symmetrical range configuration, symmetrical triangle range configuration, and see the continuation of that corrective rebound sequence extending to the upside for the next intermediate resistance to come in at 65.40, which is the minor swing high area of 23rd of May. Above 65.40 may see 67.35 next. Right, so before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today, Thursday, will be a bunch of PMI data release over here. So PMI data release day today, at the kickstart at 8:30 a.m. we see the Japan manufacturing PMI flash data and the services PMI flash data for May. So both of them actually decline as more than expected, or decline from the previous month. Not say decline, especially the services PMI for Japan decline. Previously at 52.4, it declined to 50.8. And things to watch out for next will be the Eurozone PMI data over here. So Germany one will release half an hour earlier than the Eurozone. So at 3:30 p.m. Germany manufacturing PMI flash and the services PMI flash for May will release. All right, and that could impact the euro dollar, the euro crosses, and the Germany 30 stock CFD index. Then thereafter at 4 p.m. will be the Eurozone wide release, that means comprising of all the Eurozone member, which is the manufacturing PMI flash and the services PMI flash data will be released as well. And at 4:30 p.m. will be the UK one, and at 9, not say 9, where was it? Yeah, 9:45 p.m. will be the US manufacturing and the services PMI flash data. So market participants will be paying close attention. Today will be the slew of release of flash manufacturing and services PMI data for those developed nations. Because why this data is important, basically it is survey based. So anything that's survey based is considered soft data, and soft data tends to have a much more leading element compared to hard economic data. And after the release of the US manufacturing and services flash PMI data for May, at 11 p.m. we have an ECB official speaking, ECB Edison. And what we have over here is at 11:35 p.m. another ECB official speaking, Gundos. And we will at 2 a.m. we have Fed Federal Reserve official, Fed Williams speaking over here. And before the start of tomorrow's daily dose, one tier one economic data in Japan that could impact the dollar yen and the Japan 225 CFD index will be the Japan nationwide inflation. So market participants will be paying close attention to the core inflation rate and the core inflation rate that's excluding both food and energy. So market participants is expecting a continue of a firming up of inflationary trend in Japan. So for the core inflation rate, market is looking at 3.4%. That will be an increase of 3.2% that was printed in March. So that if that rate come out as expected and above 3.4%, that could also support the continuation of the weakening of the dollar yen. All right, something to look out for at 7:30 a.m. tomorrow's Asia session. So with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you a great day ahead, and we shall speak again tomorrow. Thank you.